Moving to one of the biggest topics in and outside of crypto these days, which is stablecoins. And the way I've been thinking about stablecoins all the time is just like email, right? So we had the first generation of internet protocols, and the first killer use case was that we could send emails around the world, like to anyone, anywhere, 24/7, without any friction. So now with blockchain technology, we have the next generation of protocols, and we can also send value. So stablecoins, to me, are the equivalent of email. They're the first killer use case of this new generation of protocols. And now we can actually send dollars to anyone across the world instantly, 24/7, and basically almost for free already. And we don't need to use any intermediaries. So to talk about this, there's no one better than our payments guru, Tyler Spalding, who's the co-founder of Flexa and the founder of the Anvil protocol, which is a collateral protocol that powers Flexa and more other use cases. And Flexa and Anvil are amongst our largest TBV positions, and something that we remain incredibly excited about. And after spending years with Tyler and getting to know him, I can confidently say that it is nearly impossible to find anyone with a deeper understanding of both the traditional payments industry and crypto. And that's why he is our number one choice to explain to you what are stablecoins, why do they really matter, and of course also share some updates on what's happening with Flex and Anvil. So, Tyler, please come up.
Thank you, Ruud, for that very strong vote of confidence. But this is something I've been really excited about. So this presentation is actually brand new, so I've never given it before, but I think there's some fun bits in it and hopefully very educational. So I'm Tyler, I'm with the Acronym Foundation. Right now we focus on building and contributing to various Web3 products. I previously had started and sold 3 technology companies over the past 25 years before then getting into crypto. And I've really been focused on mainstream adoption. So how can this really be usable or valuable to many people across lots of different industries? And it's been very trying. I think this is a very adequate GIF of some of my experience in navigating crypto in general. Not only just on the regulatory side, the economic side, the philosophical side, psychological side, the community side, the marketing side, the technical side, engineering and security side. So it's just one after another of building products in this space, but it can be exhausting but very exciting. And as Ruud mentioned, I then co-founded Flexa, the largest digital payments network, which I'll give a quick update on, and then sort of parlayed that into Anvil, which is a collateral protocol, which Flexa now uses to collateralize all of their payments. So stablecoins are obviously a really big deal now. Hasib will be talking after me in much more detail around behind some of these metrics and what some of this are used for, but some of the high-level numbers of why this can be such a big deal. And then not only the numbers, because they're not necessarily vastly impressive compared to the global economy, but the rate of growth of these, when you're seeing 50% year-over-year growth on a lot of these numbers, they're going to start to become even more significant very fast. So I wanted to quickly start with just why does crypto even matter to this? So why is crypto involved in stablecoins and money, and why is this even interesting? How are these two things coming together? So the very quick kind of foundation on blockchain networks, the really big innovation there is that a blockchain network is a stateful network. So the entire network is aware of the state of the network, whereas the internet is a stateless network. So all it does is transfer data between a server and then clients, right? There isn't a number or a universal truth within the entire network, whereas a stateful network does that. So a stateless network is really great for data transfer and just moving data around very quickly and easily. Doesn't necessarily need to be trusted, but in a stateful network, you now can have value as a known quantity in the network. One of the differences between these could be, imagine something like Netflix. You're on your computer, you're streaming some movie, and the internet goes out for a second, right? So what you're gonna have is, in this analogy, there's gonna be some data packets that are lost, right? You can buffer the data in the background, but imagine that data is potentially lost, right? Your internet goes out for 1 second. In a stateless network, you just send more. Who cares? It's arbitrary to send us more data, right? If you get double the amount of data, your machine just doesn't read it or doesn't care, right? You can just get as much data as you need, you process what you need, you watch your movie, and everyone's happy. Imagine doing that with money, and I'm sending you some money through my bank, and I'm not sure if the transaction went through. The internet went out, and it's like, did they actually get this money or did they not? Did I actually send this? It's like in a pending state. You're probably not going to send it again, right? Because now you'd basically be sending double the amount of money in that transaction versus in the first example, the data is arbitrary and doesn't really matter. So you can send as much as you want, how you want to route that, how you want to consume it. In a stateful network, there actually is an actual value within the network. It's known, it's decentralized. You avoid this value transfer problem. And so combined with that, stateful networks have to be open source. It's the only way. If not everyone agrees to what the rules are and can expect the software and understand what everyone is reading from the same database and the rules of that database, it can't be stateful because then people could cheat. So it has to be open source, then it has to then be decentralized. And we're seeing that this sort of technology ends up being implemented at scale, sort of through this transition where you even had going way back to the telegraph and even like the internet itself. We started with these intranets where people would build their own email servers and they'd have floors. Some of us might be old enough to remember this, floors full of servers, running our own email servers, and all the data is kept on site, and that was the way to do it. Whereas now, that's a relic of the past, and now there's a new thing called the cloud, which is now we're just consuming the data through public infrastructure. And we can still maintain our own email clients and our rules and securities. We can consume the data as we want, but we don't need to run all that really expensive infrastructure. It turns out that running it on public infrastructure to transmit the data and be the rails is much cheaper, much more efficient. It ends up being way more safe and secure because it's a very robust and interoperable network as well. So that's what crypto is. So crypto is one of these open source, public, stateful networks, which now gets very, very interesting if you want to transfer value or units of account or some sort of an asset. And the only real difference is that because it's free to copy, modify, attack, clone, you can't make money in the same way. You can't just set up some service and then rent seek on top of it and charge a subscription because it's all free. It's all open source. So I believe Lasse probably talked earlier about this, of like how token models and incentives and cooperative models of how do you monetize this? Where does the revenue come from? How do you still make money in these systems, and how are they sustainable despite not operating like a traditional business? So now when you look at money, we have physical cash, right, that everyone is familiar with, which then has its limitations, particularly you can't use it online, and it's not digital. That book that I referenced on here, if you have any interest in learning anything about money whatsoever, this is the Bible of Bibles. The history of money is one of the most fascinating pieces of literature ever created. It's like 800 pages on how money works and the history of money and how it's been created, and it's amazing. But anyway, we don't really have a digital version of cash. We kind of have proxies for it, but what we really have is cash that's been converted into some more narrow form of money through a banking app, a bank, a payment app. It's not actually digital cash. Cash is transferable between everyone. It's a direct liability to the central bank, whereas our digital cash currently is not that. I'm not saying that that's bad, but it's not exactly a one-for-one. We don't really have a digital version of that. It's been narrowed in some capacity. It's sitting at your bank. It's a bank balance. It's a payment app balance. That's what we're actually transmitting, this database entry, as opposed to an actual unit of account. And so if you think about this with what I just said, it could be really interesting to take that money out of that environment and make it freely transferable, be totally verifiable, trusted, as real digital cash that can exist on a decentralized network that now people can move around and use in exchange for value. So it's a digital version of cash that's not exactly that, but it's a really nice proxy, and it gets all these benefits of being able to now freely transfer and verify that the asset exists. So now it gets to, all right, well, what are the stablecoins? Well, stablecoins are now sort of the manifestation of trying to bring that premise to life. The very simple piece is that it's a cryptocurrency token that's on the networks I just described, and it's designed to just have a constant value. It's typically pegged to a fiat currency. $1 is obviously the most common and the most highly denominated. There's various stability mechanisms to kind of enforce that peg, that one-to-one peg, where you want this digital cash to be equal to a digital dollar. Some methods are a lot more trusted than others. Some have completely failed. Some have been very successful. They can be totally programmable and purpose-built because at the end of the day, this is software. So there's so much flexibility on how you can actually manifest this. But I like to think of it as literally now digital money or digital cash represented on-chain. So the three types of stablecoins that you're probably familiar with or you've seen are more the fiat-backed tokens or fiat-backed stablecoins, the one-to-one collateralization. Then there's over-collateralized and the non-collateralized one, although I probably wouldn't go there too much. But we'll talk about it. So the one-for-one collateralized, I'm starting at the most basic fundamentals here. The most popular ones you're probably aware of are USDC and USDT. They're pegged to USD, obviously. They're backed by dollar-denominated assets with the intent to not have any operational or financial risk. And the idea is that an issuer creates these IOUs by saying, I owe you, there's a piece of paper essentially, which is a USD coin or a tether, and it says, I will owe you $1 of a bank deposit if you exchange this with me. So it's really just an redemption mint process, but it's really an IOU at the end of the day. And then, as you're probably aware, a portion of those deposits are invested into in USDC's case, almost exclusively short-term government debt. So T-bills. There's other assets that Tether particularly invests in. But an important distinction is that these issuers earn yield on those assets that are used to collateralize the tokens, whereas they don't earn anything from the token transactions themselves. So again, going back to like the decentralized models, they really earn money from the use of these tokens and the ecosystem built around the tokens, APIs they can create, software they can build around it, custody solutions. It's not on the transaction of the asset itself. The exact flow of how this sort of works is that a user can deposit cash with the issuing entity. Then the entity just mints a crypto token on a blockchain from a smart contract that they control. Then the tokens that they issue are completely fungible and can be transacted peer-to-peer, right, in the open way that I was describing earlier. And then the reverse should now be true, in that the user can bring back these crypto tokens to the issuer, basically send it to them, and then they will burn or remove that token from supply and then give you a cash deposit back. So that's kind of just the one way in and out. And if you look at this sort of how this works just economically or even just analogies, it really just is a credit against each of those institutions because, again, it's an IOU. So the core piece here is the convertibility of that asset. So if I can redeem this asset with this issuer with 100% certainty, then the peg should remain valid. Because if that peg if you ever see something go off peg in the market, if the price is more than $1, well, it would make sense for me to go mint them and sell them because that's instant profit to any arbitrager. And then the opposite would be true, to where if the token goes less than $1, but I have 100% or very high likelihood of redemption, well, why wouldn't I go buy something on the market for 95 cents when I can go redeem it for $1 with guaranteed certainty? So the redeemability is the really big component. Thinking about them just as tokenized bank deposits, much like kind of how a casino chip would work. But I think an even easier example that you might be familiar with are just the money market mutual funds. It works almost exactly the same, where they take deposits and then they invest them in high quality liquid assets. And then the idea is that the share value remains on par to $1, and then it's always redeemable for $1, whatever these shares are. The core difference would be the shares in the mutual funds are not sort of widely transferable. They're whitelisted. You can transfer them to other whitelisted parties, but they're not freely transferable like a stablecoin, for instance. And then also, they pay yield to the holders themselves, whereas the stablecoins, as we talked about, really pay yield to the issuers. So quickly, some of the other two, over-collateralization, so not involving fiat at all. It's a very similar process, except now you're using crypto assets that you deposit into some sort of a smart contract, and then you mint a token against that. And now the autonomous protocol is the issuer rather than some centralized entity. They're required to be over-collateralized because the underlying collateral can be volatile. So it can go up in value, it can go down in value. If it goes down in value, that obviously would be a problem because now you're under-collateralized. So they have incentive mechanisms that allow people to liquidate the collateral. So if the price of the underlying asset is going down, the collateral has various mechanisms to allow people to basically exchange out the assets, so the stablecoin asset for the underlying collateral, and basically make the protocol whole. So it's basically these fallback mechanisms to allow kind of participants in DeFi to stabilize the token value. And the way that it works, almost exactly the same as with a fiat deposit. You're depositing Ether into a smart contract that then mints the token, which is freely transferable. You can go the reverse by redeeming them to reclaim the underlying asset. It really does function like a decentralized credit facility. There's interest charged in minting the tokens. That's how the protocols have revenue models. And they represent tokenized debt, exactly the same as USDC and USDT. It's essentially just a leveraged long position. The peg is maintained not only through the arbitrage possibilities I mentioned earlier, but then also just through monetary policy, where based on just based on the price of the token, you can either increase or decrease the interest rates in order to encourage more tokens being produced or more loans being paid off, essentially reducing the supply of the token. And that does require governance in order to be responsive to the market conditions based on collateral values. So you're setting collateral factors and those interest rates that I mentioned. The tokens are generally permissionless, whereas in the fiat-backed stablecoins, they typically have some sort of admin functionality where they can whitelist or blacklist certain transactions. They can freeze transactions. It's very rare, and they will usually need a government order of some sort to enforce. But in these tokens, that doesn't exist. Then in this, not going too deep into it, but it's basically the exact same process, but now there's no collateral of any kind. It's really just based on market forces and market demand. So there's no intrinsic value within the system. And there can be algorithms or components that allow you to mint or reduce supply based on the value of the token relative to the peg. So if the peg gets broken, either up or down, you can then either mint more tokens or burn tokens to try to stabilize, in effect, stabilizing the price. There's also more exotic models where there's more economic incentives to try to enforce that, where there's a seigniorage model where if the inflation then occurs, the token needs to inflate. They give that inflation algorithmically to holders of an alternate shares token, very similar to how government currencies are created. The reverse then is true where they offer bonds, so you can basically buy bonds at a discount when the price is lower than $1. And then if you hold the bonds, it'll convert into full par value when inflation occurs. It can sound a lot more complicated than it is. This didn't work, by the way, not at all in many attempts. So just kind of highlight how people have looked at this and like some of the components of how they're stabilizing. Everyone is familiar with this one. This one is also very simple, where you can basically take Luna and burn that to get the equivalent amount of UST, which is a dollar stablecoin. The opposite was then true, and that you could take UST and burn that to get the equivalent amount of the collateral token Luna, which sort of works in practice, as well as the arbitrage method. The issue is when one side of that equation gets much, much, much bigger than the other side, which is what ended up happening. So when Luna ended up having a much greater market cap than UST, and they converts in this manner, you can see what happens very, very quickly when one side is much bigger than the other. Once people start getting out, the whole thing just becomes wrecked, and that's what we saw. Okay, so So how can we kind of approach all of this? I look at this even from a government perspective. We really should have regulation around this and better regulation because we want to make stablecoins, fiat-backed stablecoins, stable and usable. And so these are like sort of the common sense things that should really be in effect across any jurisdiction that wants to use stablecoins as money. So these are the various standards around what disclosures you need, what insurance you might need, what type of collateral assets, what the redemption processes are. So these are the sort of things that we should have in greater effect, in my opinion. There's other alternatives what you could use besides this sort of freely floating stablecoin, and people have talked about the CBDCs quite regularly. But they're a little bit different because they're now a liability between the citizens and the central bank directly, so like cash, but not digital cash. So what we've been talking about so far and everything that exists currently and the methods I just described, there's a layer of separation there where it's not a direct liability of the central bank to the end user. So if you did this, obviously the government would have complete control of how the money is used. There'd also be quite significant attack vectors because now there's one centralized entity processing everyone's money. So if someone were to compromise that, that would obviously be very, very bad for everyone. And then essentially all you're doing is then having a central bank operate as a payment app competitor, which you could do, but I would question why. Why would they do that when they already have this infrastructure? Like, who cares? That's not their business. Their business is basically controlling the currency and issuing the currency, not getting involved with how people use it and payment apps and interfaces and user experience. It also competes with banks because now they wouldn't need banks to put deposits there. They could hold them through the central bank themselves. So I don't think that it makes sense, personally. I don't know why you'd really want to implement this, besides just some very, very authoritative control. Because honestly, fiat-backed stablecoins work great in the existing system. That's sort of the point that I want to make is you maintain all the banking relationships, bank maintain the same commercial and consumer relationships that already exist. The whole process continues to work as it's been set up, without any of the other complexity. So stablecoins just fit in perfectly, like very brilliantly of all the existing stakeholders and how it all comes together. I think this works great. And then there's other people that kind of rumor about things like XRP, that banks will somehow use another settlement token in this manner. And I just don't see why that would ever make sense because you're outsourcing settlement finality to a token that isn't a deposit, isn't really money. It's not on the bank's balance sheet. All the banks don't want to hold all this thing. Why would they hold all this thing when they already have all the bank deposits anyway? So if you want to build a method like this of some sort of settlement token that everyone can then use, it really should be derived or based on all the deposits they already have that are regulated exactly the way that everyone is familiar with, how this all works. All the existing players continue to operate exactly as they have before, but now you get all these really great digital benefits. So summarizing this together, you really just get all this great settlement assurance just with fiat tokens. You get all these other benefits around all the autonomy, privacy, interoperability that now these other payment services can provide, as well as the public infrastructure. You get a whole bunch of other new elements that you can add in the digital sense, even when it comes to like AI agents and being able to transfer value automatically without other interfaces or involvements or permissions. Like this gets very interesting, particularly when it's pure digital. Some of the other DeFi products that we've sort of mentioned, as well as the reduction in fraud and error. There's a fascinating story here that if you have any interest in why the Sears Roebuck catalog in the early 1900s is one of the most significant pieces of literature that has ever been created in history, and I will stand by that. If you have interest in this, find me afterward. I will chat with you on why and how it relates to all of this. Flexa, very quickly, payments network that obviously uses stablecoins for payments as well as other crypto assets. It's really just not trivial for merchants to be able to integrate with any of these payment methods at all, mainly because of the hardware, software, the operational legacy issues they have. They have how they pay people, their back-end systems, the employees that they have to train, and all of those myriad of components. That's what Flexa focuses on, is allowing digital payments to now be native at any existing point of sale. They recently launched a tap-to-pay using a non-custodial hardware wallet, which we actually created through Burner, and we made special theta ones. So we made these really, really neat totally, fully custodial, self-custodial hardware wallets. I have a bunch of these, so if anyone would want one, you can find me anytime throughout the day. I'll be here all day. These are super cool. I can explain why, but Mark is probably going to kick me off very shortly. Flexa has been making a ton of progress. New wallets that they've now announced, some really large PSP integrations that are going to be coming online within the next year. And actually later today, because we're ahead of Eastern time, they're going to announce the base pay native support, which is really great. So now the base wallet is probably the most used crypto wallet, now has the ability to interact with Flexa natively and just select base pay within any accepted merchant that Flexa uses. Then now getting into the collateral side, collateral is sort of the underpinning of money that I talked about. So now we have a new DeFi protocol that allows you to lock collateral and use it to issue letters of credit and be able to extend credit to different apps, different users, different people, different types of tokenized assets. Basically one place where you can manage your collateral and then use that more effectively across other apps. And so that's Anvil, and it applies to money in so many different ways, which is very exciting. And I think that will be about it. So thank you very much for your attention.
Thanks, Tyler, and a lot to digest there. And if anyone wants to hear more about Anvil, I suggest go look at the long videos that Tyler's done and are available online. That'll give you the whole in-depth there.